Hello, friends, clients, and colleagues. Today is Sunday, April 11th. This is Rich Siegel with ARQ Wealth Advisors. And today I thought we can cover our firm's first quarter commentary. Let's get to it. All right, let's first start off by just talking about the last few months. Essentially, very strong stock market and economic performance. Okay, most of this could be directly attributed to the effectiveness and the rollout of the vaccines. With that comes an incredible amount of optimism and hope for the future. Okay. Additionally, these markets and economy have been propped up by the Fed's monetary policy, meaning that we're in a low rate environment, which helps to stimulate borrowing and lending. And then, of course, also the fiscal stimulus, which is actually the government issuing checks, extending unemployment benefits, enhanced unemployment benefits. And the next thing we're talking about here is going to be a mammoth infrastructure package and tax hikes to fund that package. Okay. Looking at these capital markets here for Q1, pretty interesting. You could see that the winner here on this chart was the S&P 500. That's the green line, up 6%. And then the blue line would be foreign markets developed. That's primarily Europe and Japan. Then comes the emerging markets like Asia, Latin America, Eastern Europe. And finally, what's really interesting here is a negative 3.3% return on the U.S. aggregate bond index. That's the benchmark for bonds. And the reason why this is so striking, why it's down quite a bit, and this is a big down quarter for bonds, is because rates went straight up. And when rates go straight up, bonds go down and vice versa. So rates went up, and we'll discuss that in a few minutes. Also, what's interesting about this chart is you can see that the huge winner for the first month and a half or so was the emerging markets. Okay, China represents about a third of the emerging markets asset class. It was up in the 12% range and closed out the quarter up 2%. That's a 10% drop. And the reason why that happened was when the dollar gets super strong, it puts a strain on the emerging markets specifically. And vice versa. If the dollar is weak, it's a big tailwind for emerging markets. Moving on, the economy, pretty incredible what's going on here. You can see here in this chart that we had the recession last year. We had a 6% drop, then a 30+% drop, then a 30+% rebound. Historically speaking, GDP is in the 2.5% to 3% range. By all accounts, we're going to get a number for the whole year this year of 6% plus. That's big. And it shows that this is a more pervasive rebound and recovery. This is not temporary. And over here, you can see that unemployment was at 14.4, I believe, at its worst. And back when COVID first started, the fear was that it'd be over 20%. It never got that bad. Now we're at 6%. So if we keep moving in the same trajectory, and consensus does believe that job gains will be big as the economy continues to reopen, we should move closer and closer to full employment over the next year or so. And that would be close to about a 4% rate. Also striking in the economic data is manufacturing. This number just came out recently, 64.7. That's the highest manufacturing output in this country since the early 80s, since 83. So things are really improving in the U.S. economy. Actually, things are improving globally. This is a full global, synchronized global economic recovery. All right. One of the things that I put here in the commentary that I think is key, in order for the markets and the economy to remain healthy, policy mistakes must be avoided. And by that, what I'm referring to is if for some reason the Fed were to raise rates sooner than later, that could put a jolt into the system. That happened at the end of 2018. Jerome Powell said we're on autopilot. And if you recall at that point, the overnight lending rate that the Fed controls was in the 2.25% range, and the markets got nervous and dropped 20% actually in about 4 to 6 weeks. Another thing would be if these tax increases, these policy proposals are effective January 1, and they all go through, which is highly unlikely. Additionally, they'll probably pass some type of tax hikes that will be more bipartisan. So moving on to the equity markets briefly here, we can see that there was two major trends for Q1. The first trend was the outperformance of value stocks versus growth stocks. The green line here is a 10% return for the quarter in value stocks, where the blue, minus 0.73, was large cap growth. Now, large cap growth has been outperforming for a very long time. And that said, large cap growth stocks are trading at valuations that are quite high. Value stocks are trading at valuations that are more in the range of historically normal. Now, value stocks can be defined as sectors that are more economically sensitive or cyclical. For example, financials, energy, materials, and industrials. Growth stocks, think big tech, communication services, Amazon, Google, Microsoft, etc. Also, biotech and consumer discretionary. These have had a tremendous run-up over the last several years, and during COVID, they were the big winners of the stay-at-home market returns. We think this is reversing. Now, there will be periods of outperformance, of course, with technology, but value stocks are more tied to the economy. So if you believe the economy is going to recover, and it looks like it really is, these value sectors should outperform, and they're cheaper. Okay. They also tend to do better when interest rates are moving up, which is the case today. The second major trend for the first quarter was that small and mid-cap stocks outperformed large caps. Pretty similar thesis here. Here's the small cap Russell 2000 index up almost 13%. Here's the S&P, much more volatile. And that's also typical, right? Small cap stocks carry more volatility and more risk than large caps, higher highs and lower lows. Now, the percentage of sectors like financials, energy, materials are higher in the small cap index, and technology is lower in the small cap index. So this is tied to sector performance. It's tied to the reopening of the economy. And again, small caps, especially on the value side, are much more attractive from a valuation standpoint than large cap tech stocks are today. Finally, take a quick look at this chart here. Quite interesting. The blue line is foreign equities. This is the whole global market minus the US. And the green line, again, is the S&P. And you can see here there was pretty significant outperformance of foreign stocks till about this point here. And this is interesting because right around here, the dollar began picking up strength for the first time in several months. And the reason why that happened was because of the tremendous US economic data coming in, which caused a rise in interest rates. And usually when you have the US economy outperforming other economies and higher interest rates in the US, that strengthens the dollar. We think the dollar strength is going to be short-lived, and that foreign stocks really have the opportunity to outperform both in the short and intermediate term based on various reasons, one being that they have further to go as far as vaccine penetration. They have further to go on growth because of valuations. They're just trading at a much cheaper level than U.S. stocks are. As far as bonds go, bonds, and we lump bonds in with non-traditional assets, meaning liquid, low-risk liquid alternatives. We've been pretty conservative by design in this space, and you can see what happened last quarter. Quite interesting. The quarter started out with the 10-year Treasury benchmark yield trading at 0.93%. And by the end of the quarter, it almost doubled to 1.74%. This is a very big move, incredible velocity, probably the one of the most rapid increases in rates ever. Now, when rates go up, bond prices go down, right? So what you see here is that our holdings in our client portfolios on a weighted basis for the entire quarter was down 0.42%. That's very benign. In fact, if you think about 0.42%, that's a bad day in the stock market. This is a quarterly return, okay? These are various bond benchmarks for the quarter. You can see here that long-term 10 to 20-year treasuries were down almost 12% in 3 months. Okay, the aggregate index, as we mentioned earlier, was down 3 1/3. Okay, global bonds were down 4 1/2, and U.S. investment grade corporate bonds down 4.6%. So being conservative and defensive in this area of our client portfolio has really beared fruit in Q1. We would expect the yield curve to keep steepening as the economic data comes out, and that's actually healthy. Bond yields historically are not 1 or 2%. They're more in the 4 to 5% range. We think they'll probably grind slower now in a more predictable fashion, probably closer to 2% in the coming months, which is a pretty small increase from here. Okay, and to kind of wrap this up, I would say that things are really improving. Okay, COVID cases are down probably close to 75 or 80% from the peak. And most of the new cases tend to be in individuals in the 20 to 40 age range. Okay. Mortality, hospitalizations, all of these numbers are way, way down. We have lots to celebrate here as we grind towards herd immunity and more vaccine penetration. I would say, though, that the economy does not have to follow suit with the stock market. They could decouple for a while. Now's not the time to back up the truck, I said here. In order for stocks to maintain their values and to keep going up, two things really have to happen in our assessment. One is earnings need to deliver. Earnings are the mother's milk of stock prices. Earnings growth is very highly correlated to equity prices. So we're coming out this coming week. Earnings will start coming out in the financial sector and the technology sector. Earnings growth is expected to deliver 20 to 30% growth this year. Coupled with that, interest rates need to stay low. Okay, if interest rates keep going up, the cost of borrowing, the cost of lending goes up. And at some point, if rates get high enough, bonds become a competition for stocks. So we feel that stocks are a bit expensive here, broadly speaking, in the US. However, if you back out 5 or 10 of these mega cap tech stocks, the valuations of the S&P 500, for example, are on the higher end of average, I would say. And that's really where we're starting to focus more client portfolio allocations in the value areas. They're cheaper, they have more to rise, and they're more attuned to economic metrics. Okay. The last thing I'll say here, and there's not a chart for it, is in recent months, the amount of cash being accumulated by both institutions and individuals has climbed again. There's $4.5 trillion in money market and bank deposits. $4.5 trillion, earning zero. And that money has to go somewhere. And as things normalize and get healthy, confidence will rise and that money will start to move back into risk assets, real estate, junk bonds, and the stock market. And that could be a floor for equity prices as well. So with all that, I hope this was valuable. Thanks for listening. Have a wonderful day, and we'll speak to you soon.